I think we've been talking about interest rates going up for quite some time now, and we've been positioned conservatively in the investment grade space, specifically because duration is very high, meaning that there is a lot of interest rate sensitivity. So we've been negative on the investment grade market because of that. I think the inflection point that we're seeing now is that we've had a 10-year period where corporate entities have come to the market and been able to finance at increasingly lower rates as rates have been coming down. We're now at a point where they are financing their debt at a higher rate. So we've got something like $600 billion of debt coming due next year that will be financed at a higher rate than it has been in the past.
Hey, Monica, thank you so much for coming on. I want to ask you about this conundrum then. If you say that corporates are now going to have to finance or refinance at higher rates, the reason that's going on is because the economy is improving. And with an improving economy, you're seeing companies that are able to raise prices, you're seeing companies that are doing more in sales, and arguably are getting stronger as businesses. So doesn't that offset the fact that they're financing? Doesn't the increased strength of the corporate balance sheet and position in its market offset that concern that they're financing at higher costs?
Right. Well, that is a good point. And I think earnings, our view is that the economy is doing well, the corporate profitability is increasing. I think you just said, earnings are going to be up over 20% in the third quarter. The issue is that absolute leverage is close to all-time highs. So while we've had earnings growing, we've had debt growing at a faster pace.
Not the consumer, corporations.
Corporate. I'm speaking specifically
Agreed.
about the investment-grade corporate market.
On that note, a lot of us have noted, and I'm sure you have too, a wide swath of triple B that's out there.
Correct.
And the concern is, if you get into a recession, some point we will have a recession, and that gets downgraded. We all know that gaps down when you go from investment grade to high yield.
Yes.
The follow-on effects on ETFs, are you worried about that as all of a sudden people see these big drops in their investment-grade ETFs as these triple Bs get re-rated and priced lower?
Oh, for sure. That is something that we're monitoring very closely in the market. The triple B space is now half of the investment grade corporate market, whereas 10 years ago, it made up about 20% of the investment grade corporate market. Historically, when there is a downgrade cycle, about 10% of the investment grade market is downgraded. So you can do the numbers. If let's say the triple B space is at $3 trillion, our market's a $6 trillion market, we could be looking at a significant amount of downgrades. And the high yield market is a much smaller market than the investment grade market. So that's where the concern is. Can all of that paper get absorbed into the high yield market? Yeah.